Hi guys, for those who are joining us, we'll start shortly. I guess 1-2 minutes. Ben just went to grab a cup of coffee and we'll start shortly.
On time.
Amazing, Ben. Great to see you.
And you?
Uh, we'll start right now. A few people are joining us online, a few people here on Zoom. How is life? How are you?
It's busy. It's just the nature of it. It always is.
It's great to connect. I think we saw each other, I think, 10 years ago when you were near partners in your office, but time flies. I just would like to make an intro for everyone here on the call, but also for those that will join us online and in recording. So Ben is the founder himself, 25 years as a founder, and then more than a decade as an early stage investor. He's right now a general partner at Tenacity Venture Capital. Notably, he invested in Lending Club, Zenefits, Branch, Cabbage, and many more. So Ben, welcome. We're going to have about 50 minutes. I'm going to ask a couple of questions as usual, and then we open to founders that join us
Great.
on this call. So yeah, the first question, just to kick off, maybe you could share some of the insights into your journey from being a founder, but also in contrast of being an investor.
Sure. When I first moved here, it's funny, I now get all the calls that I tried to make when I first moved here. So I was, as you pointed out, an entrepreneur for 25 years. I started companies pretty much my entire life. And the most recent and material one was that I started a company in 1993, which was one of the first commercial .coms. And I took that public in 99. Now, I never raised venture capital, so I had no exposure to the category at all. But when the bubble burst, I had control of that business and was able to take it private, which was a great way to get basically all the shareholders the same amount of money per share versus me just selling my control stake for a premium. Because it was important to me that sort of everybody be treated equally. They had made a bet on this vision we had for the web, and the world changed, but it wasn't, my job to then go off and, profit from the fact that I controlled this public company or to invest their money in something they didn't have any interest in. So I felt like the right thing to do would be to put the money back in their hands and let them make their own decisions. So did that, moved west, ended up in California about 20 years ago, and saw this big gap in the market between angel and venture. Basically, angel was small and slow, and venture was getting very, very big. And so in parallel to that, as the amount of money in venture was going up, the cost of starting a business was going down. And there was this gap where basically you had smart people with great ideas that didn't need a whole lot of money to get started and get it going and either prove or disprove their idea. And so in 2007, I started what became one of the first institutional seed funds in the world. Now, the journey to get there, when I first moved here, I was just trying to figure things out. So I would meet people and I'd say I made some mistakes. One, I was way too coy. I was like, yeah, I don't know if that's, a buddy of mine that worked at Kleiner Perkins said, oh, you should come talk to our team. And I said, well, I really want to feel things out, see what everything's all about first. I should have just gone and talked to them. Someone offered me an advisory role in a company, and I demanded, cash per hour and a minimum guarantee and equity and all this stuff. And they're like, that's not how this works. I'm like, then it's not for me. I should have just tried it. I should have tried it and figured it out. So, I did talk to a couple people. I had friends who had been funded by venture, so I'd have lunch with their friends who were VCs. And so everybody that's an entrepreneur eventually calls a VC that they know and say, hey, I think maybe I should start a fund, or maybe I should join venture. And it's a really difficult conversation because it's an exceptionally hard thing to do. So I ended up finding my way into basically a developing niche, right? Like seed didn't exist. And so typically the way you create outsized success is to find something that hasn't been conquered yet. And serendipity is always a part of it. Luck is sort of the combination of how hard you work and how much opportunity comes your way. But I ended up running the equity practice of a large venture debt shop. They wanted to be able to invest more equity dollars and build better relationships with these VCs. So I did that for about 8 years, and I got to know well over 300 VCs. I fully expected that many of those VCs would be asking me to join their firms, quickly, as they saw what a great investor I was. Turns out that took a lot longer than I thought. It took 8 years, and it took Lending Club going public in what was at the time the largest IPO of the decade, the largest tech IPO of the decade. And then all of a sudden, they're like, "Wow, we know you're a great investor now. We really want to, we should talk." And I was like, "Wait, yesterday you didn't know? Like, my companies are awesome. You always want to meet them. You always want to fund them. They're growing like crazy. Their valuations are going up." But sort of that was that final stamp. Oh, one of your companies went public that you seeded. Okay, now we get it. So I spent about 7 years in traditional venture, primarily at NEA, New Enterprise Associates, which historically has been the largest venture firm in the world and was always my favorite. And then when they discontinued the seed practice, I spun out to start my own fund. So that's Tenacity Venture Capital, which you talked about. We have no website, but if you go on LinkedIn, we're there. Ben Narasin's LinkedIn attaches to the Tenacity LinkedIn, and that's as close to a website as we've got. But it's certainly not deal flow is not a problem, but finding the right deal flow is always a problem for everybody, and it's a separate conversation. But so net, it was a long, circuitous journey, and I think the thing that added the most actual value to me was my time as an entrepreneur. That's what has helped me as an investor. But what got me the opportunities to be in the position I'm in today was the success of the founders I have backed and the deep network of VCs that I've developed over a very long period of time.
That's interesting. What are some key lessons you learned from the success of those investments, but also the failures? Maybe any anecdotes from
I mean, there are
those?
so many. It's funny. I was talking to a friend of mine once. We were going to South by Southwest together, and he was on the phone all the time. And he was clearly dealing with issues on behalf of his portfolio companies. Specifically, the issue of the fact that one or two of his portfolio companies had venture debt, and the company wasn't doing that well, and the venture debt people were getting worried, and he was trying to basically appease them and make them feel okay that they shouldn't pull their cash out of the bank. And he hung up the phone and he said, I guess I realized I can't invest in anything if there's even a single blemish. And one of the things all VCs learn eventually is the companies that absorb the vast, significant amount of time are the ones that get into trouble. Your strong companies do fine with or without you, and they don't need you that often, if at all. Your weak companies need you all the time. And so you have to be incredibly rigorous at the beginning. You can't predict that everybody's going to be great. You want them all to be, you believe they will be. But one of the things I've learned multiple times and learned again recently. So one of the biggest challenges for venture. So venture doesn't grow by hiring very effectively. It takes an incredibly long time to get a job in venture, an incredibly Sisyphean process. And I talked to one of my friends that was a very senior at a firm once, like, "Why is this such a ridiculous process?" He's like, "Ben, when we bring somebody in at a partner level, general partner anyway, we're going to be spending 10 years with that guy or gal. We need to know it's the right decision. And everybody has to sign on." So it's a very painful, very long, very slow, torturous process to build a firm through adding headcount. So traditionally, as firms get bigger, they grow initially through larger check sizes, all right? If you went from a $500 million fund to a $1 billion fund, you don't double your headcount, you increase the size of your checks. One of the consequences of that, and one of the consequences of the way in which people are brought into venture, and the fact that a lot of young people come into this business with no entrepreneurial experience and no gut at all, is that they lower the bar. They lower the bar primarily for their younger folks because they want them to learn, but they do lower the bar. And in the heyday times, they lower the bar in what they're willing to pay. They pay crazy prices because they have no other choice if they want to win the right deal. Later, when things change, as they did 2 years ago when the markets fell apart, they raise the bar again. It's funny. I was at a $300 million fund and a $3.6 billion fund. And in both of those funds, on Mondays, we would always debate pace The small fund was worried we were going too slow and we needed to deploy more capital. The big fund was worried we were going too fast and we needed to slow it down. And in both cases, I said the same thing. I'm like, this is an idiotic conversation. I'm sure I didn't use those words. Pace is not controllable if you maintain a high bar. Are you telling me, in the case of we should slow down, that if Facebook comes in on Monday and Google comes in on Tuesday and NVIDIA comes in on Wednesday, we're going to say, ooh, we're going too fast. We should pick which one of those to fund? Absolutely not. So pace should be determined only by the quantity of high quality companies that you find and are able to fund. Now that's a pain. Makes it hard for your LPs. Makes it hard to understand when they're going to get their capital calls. Makes it hard for the people who are trying to do their job. But, you know, to try to artificially push a certain number of deals per X into the pipeline, we will only do one deal a week. We will only do one deal a month. Really? So you're going to pass on great stuff. We found gold and platinum and diamonds. Yeah, we can't pick all those up off the ground. Just pick one. Diamonds? Okay, yeah, leave that platinum and gold for somebody else. No, that's not logical, but it happens all the time. It's like a pendulum. We get too permissive, then we get too restrained. Look, last year, while we were counting, I stopped counting, so I don't know the actual number, but we were on pace to see 8,000 pitches last year. And I funded 3 companies. Now, I'm not saying that's the right or wrong decision, but I know what my bar is. I know what I'm looking for. I can't necessarily say it in words, but I can. I'm looking for entrepreneurs that make me say, wow, future mega public company. I found 3. I funded 3. It's not like I bid on 30 and only won 3. I've put out 19 term sheets. I've won 18 deals. And the 19th deal I lost to an M&A transaction. So, you know, I have had a good success rate, probably because my founders are great advocates of mine. If you go on my or the LinkedIn webpage for Tenacity, you'll see like 30 video testimonials from my founders, and they're great references for me. And I have a deep history and I have a deep network. I mean, I know over 300 VCs of the top 12 funds. You want to get to the right person at the right time, as long as I think you should, I will get you there. But I'm proud of that. But net, it's just a part of the business. So, you know, keeping the bar high is an exceptionally difficult thing because it creates a lot of stress for you, right? Think about it. I did 3 deals last year, and they were all in the first quarter of the year. I have not done a deal for a year. Doing deals is what I do. Like, it's what I'm paid for, right? It's what I love. I love working with my founders. I love helping my founders. I love doing whatever they want me to do. But, you know, like, the analogy I use, and then I'll stop this ramble, we can go to the next question. But like, when you think of a big fund, I describe the metaphor of, like, I won't name the fund, but there's the guy that runs this one fund. He's like the alpha lion. So in lion prides, the female lions do all the hunting. The alpha lion basically sleeps a lot of the day, as far as I can tell, and is there to defend the tribe if they're threatened, and also maybe to take down the biggest of the big game. And the ladies go out and do the work. Right? That's sometimes what a big fund can be like. The individual partners are out there doing their own job. They can take down their own game. I'm not saying they can't. But if it's a really big target, bring in the big guy. That's not me. I'm a fund of one. I'm like a cheetah, or whatever the fastest animal in the world is. It's a cheetah, right? So I sit there on the savannah watching those gazelles go by. And last year I watched 8,000 go by, and only 3 times did I get to jump up and run at the speed of the fastest animal on the planet. Because that's what it's like when you're in deal mode, when you found the one you want and everything else disappears and everything is myopic, and it's 100% of your energy and time to figuring out, are you right? Is this the right one? Do the diligence, do the work, you know, spend the time with the founder, show the founder what you can do for them, convince them that you're the right person, because you got to win the deal if you want to take it down. And so if that's if that metaphor holds true for me, that means I've been lying on the savannah for a year. I have not been able to run. That is quite frustrating. But I guarantee you, I once got to the point where I said, oh, I better just go ahead and run anyway. I'll just pick the best gazelle. Didn't work out at all. Not a good idea. You can never lower the bar.
What are the things that you're looking for above the bar? What kind
Well,
of
my fund is named
traits?
Tenacity
Yeah,
for a reason, right? So I do
yeah.
believe tenacity is the only secret to entrepreneurial success because brilliance is assumed, or I wouldn't have funded you. A great idea is assumed, or I wouldn't have funded you. A huge market is assumed, or I wouldn't have funded you. So you can see from that, I always say I need 5 things to make an investment. People, 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 a great idea, and a huge market if it works. I don't want to fund into possible pivots. I have funded really smart, successful people before with ideas I didn't like, thinking, oh, maybe they'll figure something out. While there are very famous pivots, you can count them on one hand and you're going to have fingers left over. There's many, many, many pivots that are long gone because they didn't work. Because pivot is another word for fail and try something new. So I don't mind when, if you think of the difference, like a pivot metaphorically is sailing your boat out into the ocean, trying to get to that island of Series A, failing, turning back, sailing back to shore, and starting over again and finding a new island. I don't like that. I don't mind if you want to tack into the wind. One of my favorite stolen sayings is firm on vision, flexible on path. You're going somewhere, you're sailing in the wind and that wind is tough, but all of a sudden you just, if you just tack over a little bit here. I'll give you an example. There was a company called Chegg that I got involved with early on. They started off as a bulletin board for college students to do all sorts of stuff, like a wiki for college students almost. And what they noticed was all the activity was in an area of their site for textbook exchange. So they spun up a test business, which I believe was called Textbook Flicks, Netflix, but for textbooks. And they rented textbooks and it did really well. So some people would say pivoted into that business. I would argue they just found the best part of their business and tacked into the wind and did that. They didn't sail back to shore and start over with a failed business. They found the best part of their business and they accelerated into it. And it's obviously morphed since then, study aids, all that sort of stuff. So, that's different than, the most famous Twitter story. The famous pivot story is Twitter. A friend of mine funded him. I won't name him in case he doesn't remember saying this or doesn't want to be credited for it. But so he funded the guys at Twitter. They go off to do this microblogging site. They come to him and they say, it's just not working. This business doesn't make any sense. It's not going to work. It failed. We have about half the money left. We're willing to give it back to you if you want. Or we found this idea along the way we're sort of intrigued by. And my friend, to his credit, which is pretty much the same thing I would say, I hope, I have said it before, said, I don't want a refund. I bet on you. Go ahead, do what you're going to do. Like, keep going. He said, but why don't you go ahead and tell me the business idea? And they explained what Twitter was going to be. Well, there's this 128 character thing. And what he said was, at that moment, I said, oh shit, I should have taken the 50 cents on the dollar back. So that's a pivot that worked. But that's one of, I can think of 2 more. I'm sure there are a few more, but there aren't dozens. Like, that's just not how it works most of the time. Most of the time, I like to fund the entrepreneur that I want to fund with the idea I want to fund into the market that I want to fund.
I listened to one of your podcasts. I think it was with Jason. I'm not sure if it was this weekend podcast, but a long time ago, you were telling the story about Parker, the founder of Zenefits. What did you see in him as a founder that got your attention to invest? What was, besides tenacity, of course, but was it any, I don't know, things that you saw in the first place that you see in
Well,
great
he had an
founders?
enormous amount of drive, which is critical. I think one of the things I've learned, going back to your earlier question, which is relevant to this, is the businesses that have done the best for me as investments, and by the way, at least one that lost me almost all my money, were exciting to me the minute I heard them. The first moment I heard the idea, I was like, wow, Lending Club is like that. I heard Renaud talking about what he was doing. I was like, wow. Parker basically explained the business to me. And I said, wow. His explanation was, it was longer, but net, he'd been looking for the right opportunity. He started looking into opportunities within the sort of then freshly coming or freshly created Obamacare realities. And he ended up talking to a broker, and the broker was all upset. And he was like, why? And he said, well, we used to make a 19% commission, and now we make 12. I don't remember the exact numbers, but something like that. And Parker said, well, what do you have to do? Well, once we sign up the client, really nothing. And he was like, wait, you make 12% of insurance premiums for basically nothing after you sign up the client? So we looked into it. You can't give kickbacks, right? You can't say, if you give me $100,000 worth of insurance business, I'll give you a $10,000 rebate. But he had the brilliant idea that you could give them software. And so basically his model was, I'm going to build phenomenal software to basically do everything that TriNet would do for you, to manage all of your, HR related activities. And in that software was a button. And if you click it, it will change your insurance broker of record from whoever you're using to us. And we'll make $1,200 or $1,900 per head the minute you click it. I was like, wow, that is brilliant. You're going to give somebody an enormously valuable piece of software that makes their life better. They're going to want to convert their people because it'll probably make the software better now because that's the way you'll play it. And then you get paid now and forever unless they leave. That is crazy great. Now, look, I did not know at the time what a ferocious competitor he was and how he could just, his ability to grow businesses. When they raised their round, I think it was their Series A, we were spending some time together. I never get to see Parker anymore, but I think he's awesome. I think people had crowned him sort of the fastest growing SaaS business of all time. He said he wasn't sure if that was true, but I'm like, that seems like a good quote to me. He's a very, very focused, hardworking, smart, driven person. I will tell you one other thing. He had a huge chip on his shoulder, and I like that. When people have something to prove. Like in my own mind, I sort of use metaphors around how I sort of think about some of my founders. Like I have one founder that's sort of my Zuck, thoughtful, engineering driven, smart guy like that. To me, Parker was always my Larry Ellison. Larry Ellison there's this story about Larry Ellison that basically boils down to the fact that he needed to prove something early in life that he was not able to, and now he's proven 1,000 times over, but it's just never enough. It's never enough for that guy, as far as I can tell. And I don't think it'll ever be enough for Parker. He's just a fierce competitor that needs to prove something to the world and maybe to himself. And that sort of drive is awesome because that comes from within. That isn't taught, right? That isn't, I guess it's acquired in some ways through the realities of your life. But I lived a life where I took a company public, and it was on the back of just an enormous amount of personal drive and ambition for something I needed to happen. What people need and what they want are very different things. And when someone truly needs something, they will drive to that till the ends of time. They will suffer incredible pain. I do CrossFit. I think it's a great workout routine. It's, very intense, very short, and just super useful to me. But I'm always stealing quotes from my CrossFit coach. And just yesterday, we were working out, he said, there's a cost to everything. You can have the cost of the discipline and pain it takes to achieve the thing you're working on, or you can bear the cost of regret later if you don't, right? When people have a need and a drive, they will bear that cost at the beginning because they are not willing to bear the cost later of the regret. Now, I saw that in Parker, I guess. Maybe I'm wrong, by the way. He won't see this, but maybe he'll be like, dude, come on, man. What are you psychoanalyzing? That's all bullshit. I'm just smart and hardworking and great, which is also true. He is smart and hardworking and great. So.
How do you, in the current, so you made 3 investments. Anything you can share in terms of this? Why did you invest, or maybe what the startups do?
Sure. Well, I've made 18 in total. We probably have about 6 left in the fund. I did 9 in year 1, 6 in year 2, 3 in year 3. If we continue in this trend, it's going to get very difficult very quickly. Divide by 3. I will do 1 this year. That would be bad. That's not my plan. I normally expect to do sort of 6 to 9 is the norm. Historically, I was always sort of 6 to 10 when I was doing seed exclusively. So one of the companies, I can tell you, they are financing effectively the cost of a filed insurance claim that has been approved. It's called Claim Setter. It's out of New Hampshire. So basically, you as a business owner, I don't know, truck drive through your front window. You got to close down your business, cost you $300,000 to repair it, and you lose $100,000 of revenue during the time. Once the insurance company has approved the claim, you will be reimbursed, but not yet. And so they step in and will finance effectively the construction. They will work on getting you the people, et cetera, et cetera, et cetera. And then they'll take it's basically they arb in between. I think that's a super smart business because those business owners, just the fact that they're getting the money later doesn't mean they have it available to them today. I funded a company down in Mexico called Midas, which records and rewards cash transactions. Now, both of those are fintech businesses. Half my fund is fintech businesses. I don't have a half my fund is fintech mandate. It just happens that's where I found things. The company Midas in Mexico, it's Midas.mx, records and rewards cash transactions. So roughly 90% of transactions in convenience stores, which is where they're starting, are done in cash in Mexico. And they'll be LATAM in total, but right now they're in Mexico. Also, only 40% of people in Mexico have credit cards. And apparently they use them quite differently. They like keep them for emergencies. So when I hear pitches for the underbanked in the United States, it has never been of interest to me, mainly because I don't think that banks themselves are that rapacious. And, there might be convenience to a neobank, but I don't know that it's, a hard need. But in Mexico, these are Trojan horses into giving these people their first credit card equivalent on their phone. This is like when the wall came down and, in the Czech Republic, you had to wait 6 months to get a landline, but you could get a cell phone in 6 minutes. Same thing. Like, why would you get a credit card? Just use my app. Boom, it's in there. And now they just signed, well, I bet I shouldn't say it, a major consumer goods company, and the bottler of that major consumer good that you buy in convenience stores is probably the number 1 or 2 product in there for direct B2B and for B2B2C. So, and they are already in 1,000 stores. Now, we pre-seeded both of those businesses, which on its own is relatively rare for me. I think I've done 4 pre-seeds out of the 18 deals that I've done. I usually do seed. The key difference for me, by the way, is seed, you have revenue. Pre-seed, you have an idea. There's all, you could talk about the size and quantity of dollars in these, but, it all is highly variable. I literally saw a company yesterday where they said, well, we raised I think they might have called it a pre-seed, but maybe they called it a seed from so-and-so. I'm like, oh, how big? $14 million. And I was like, ooh, well, that's quite a pre-seed, man. But, it's a hardcore tech company and they need a lot of money, but, still it's not a fit for me. I write $1 to $3 million checks and I'd like to buy 10 to 20% of a company depending on stage. I don't always achieve that, but, net, if you raised $14 million in your pre-seed, I am not a fit for you for your seed because you're not coming to me for 6, which I can split with somebody for 3 apiece, or a pre-seed where I could do the whole thing. I can do the whole thing on a seed, but I see seeds $2 million all the time. Just a question of where people are. And now, seed has replaced Series A. Series A today just replaced Series B. I wrote an article about that for TechCrunch like 7, 8, 9, 10 years ago, how it was starting to happen. Now it's an absolute. The fact that you can raise a $14 million seed, okay, that's not a seed. That is a Series A at any point from 5 years ago to 25 years ago. And it's a big one. But realities have changed, and that's fine. I just like the old-fashioned ones that are tighter. $2 to $6 million is probably my sweet spot. And even 6 is tough because that means I have to put in 3 and I have to get another guy to put in 3. And then I'm at the absolute top of my limit of dollars and probably not getting the ownership I want because I don't want the entrepreneurs to dilute themselves too much. It's always a tough dance, right? I want to get at least 10%, but you don't want to get diluted too much. If you're raising 6, that means basically I've got to pay, if I'm putting in 3, it's got to be 30 post, 20% dilution. Okay, that's acceptable. I think 20% dilution is fine for any real round. A seed, which really is an A, an A, which really is a B, right? But it's the limit for me, 10% on one side, 3 million on the other. And it probably is the limit for you. I used to realize, one thing that has changed a lot, a year or 2 ago before the market, 3 years ago, certainly, but maybe 2, if someone said, 60, what I realized is I either said yes to 60 or I said, no, thank you, and I'm leaving because there was no negotiation. Now, because times are so much tougher, and last year, like half of rounds were down or flat, people are more open-minded to a what I would call logical conversation. By the way, no one's ever going to be happy. No one's ever going to, like, no investor's going to be like, I got a great deal. And no entrepreneur's going to be like, I got a great deal, right? You got to find a place that there can be balance. How is it logical? I'll give you an example. I paid $2.2 million to buy 20% of a company that was a pre-seed. They still had jobs. The documents were PowerPoint slides, and they had $50,000 of side hustle revenue. 11 million post. How is it logical in a traditional old school world of cash flows and everything else that I'm paying $11 million to buy a chunk of a company that doesn't exist yet, where the people still have jobs and threw together some PowerPoint slides? It's not logical, but it's the reality that we live in. And I am very, very happy with that company. The entrepreneurs have kicked ass. They've raised an A. They were offered a B. They took a note instead. You know, like they're very consistent, and they're just growing and growing and growing, and they're awesome. And every month when I do a call with them, I'm like, where are we on the number? And it's boom. And you're like, oh yeah, you did it again. It's just great. There's nothing better for an investor than consistently getting honest, good news. I don't want to hear dishonest good news, and I don't want anybody to protect me from bad news. I want there to be no surprises. I can't help people when there are surprises. You know, it is very, very, very hard for an entrepreneur to be totally and completely surprised by anything significant. And the worst example of this ever, it's only happened to me once, and that's why I do monthly calls and I ask 3 questions: cash balance, burn rate, revenue for the month. And then I ask 3 more questions: what's going well, what's going poorly, and how can I help? And I do that with every one of my founders on the first Monday of every month. Well, why do I do that? Lots of reasons. I want to know what these guys are doing and gals are doing, and I want to know if I can help and everything else, but I want to keep track. I actually have a physical notebook I write this stuff in. Because many, many years ago, probably 8 years ago, a founder of a business that I had led the investment in, which was rare for me, I only did that like 3 times back then, called me and said, Ben, I need your help. We missed payroll. And I was like, wait, what? Missed? Past tense? Like, how can it be now that you're telling me this? Well, and he had an excuse for why. But I'm like, there is no world in which you tell me after you miss payroll. What do you think I can do? You want me to go to my partners now and say, hey, I've got this founder. He didn't tell me, but then he went ahead and missed payroll, you know, like with no warning at all. I think we should give him some more money to help him out. What do you think? Absolutely not. Like, I'm not even going to ask that question. If you're going to miss payroll, you know, okay? You know you don't have the cash the day before. You know you don't have the cash the week before. You probably know you don't have the cash the month before. You could easily be a quarter out and have visibility into that. And so if you're not paying attention to your burn, you know, hope springs eternal, but hope doesn't pay bills. So, you know, like, I want to always know, because then I can say, hey, we're down to 6 months of cash. We got 600,000 in the bank. We're burning 100,000 a month. How are you thinking about that? Is it appropriate to think about raising? Now that'll depend on the business more than the cash, right? Should we think about cutting burn? Is there a way we can bring in more revenue? Is there a way we can reduce costs? Like, we need to get ahead of this. Venture debt folks, as an example, in my experience, when you're down to 6 months cash, you go on a watch list. They're paying a lot of attention. No one should ever get down to 6 months cash without a lot of conversations happening about how to change that. That's just good business. I mean, I prefer it even be long. Obviously, everybody would much rather you have 12 to 18 months of cash. But my point is, you don't show up the day after you ran out of money to explain that you ran out of money. That is not good. And I never wanted to have that surprise again. You know, my favorite quote from anybody ever around board meetings is, I care about one thing: no surprises. I think that's a great way of thinking about it. Good news can travel as slow as it wants to. Bad news should travel super fast, because that's the only chance I have that maybe I can help. Maybe I can't. There's a very good chance I can't help. But why not take a shot? You embarrassed? I've been an entrepreneur for 25 years, man. I came that close to missing payroll. I had to basically beg, but we made payroll, and we survived, and we got that company public. You have not lived through any hardship I have not lived through. There are no surprises to me when you tell me how horrible something is. You know, being an entrepreneur is the hardest job in the world if you're not a first responder. If you work in an office and you're an entrepreneur, you've picked the hardest job there is. I did that job for 25 years. I get it. It's really, really hard. Things go wrong all the time, far more often than they go right. How you deal with them is the measure of the man. By the way, that was gender neutral. Man, human. I have some phenomenal female founders. They're awesome. And I never want anybody to think that, look, I do not care. I don't care if you're a man. I don't care if you're a woman. I don't care. There's nothing about you related to your heritage and genetics and, you know, what makes up your DNA that I care about. I care about the DNA of your tenacity. I care about the DNA of your intelligence and your drive and your ambition, and you're willing to deal with hard things. I want you to be honest, you know, but I hope one day to fund a sentient purple octopus from Venus and say, look, it's a meritocracy. This is the first purple sentient octopus I've ever met, but wow, did she have a great idea? And she is willing to work really hard. I'm backing this octopus. I know it's going to be hard because I don't know how she travels. Anyway, you know my point. Like, I get a little itchy when people sort of, I couldn't raise money because fill in the blank. Usually couldn't raise money because business didn't justify it. I think for the most part, venture is one of the most meritocratic industries in the world. Maybe not as much for the getting into the industry of venture, I will admit that. It was a long, torturous road for me, and I'm sure it's going to be that way for a lot of people.
Thank you, Ben. In this winter, in this tech winter, what kind of examples of startups from your portfolio you see that they're navigating or thriving, maybe not just surviving, but thriving in this downturns? Anything that sets apart them, or anything you saw in those entrepreneurs or teams?
Yeah. Well, look, I have been fortunate. I guess I'll put it this way. I am reaping what I sowed. So that keeping the bar incredibly high, I say to founders all the time, founders I didn't fund and founders that I do, I'm not looking for the top 1%. I'm looking for the top 1 BIP, right? 8,000 pitches and I funded 3. I should have funded 8. Now, the reality is we probably didn't end up seeing 8,000 pitches because I did stop counting and I changed our strategy. I'm going to guess we certainly saw more than 3,000 pitches. But so if I am going to continue, what I believe is true is that because I've been so hyper-focused of picking that elite tier of top 1 BIP founders and opportunities, they have done exceptionally well because everybody wants to fund them eventually. I'm just taking a different risk than most people because I'm going earlier. But as an example, whenever I would open PitchBook last year, every quarter, half of all rounds were down or flat. That's horrible. Of my 18 companies, 15 in the last 2 years have raised rounds after us. All but 1 were up, some materially. I have 2 companies I've funded where I seeded them and they've already raised an A and a B. I mean, that's amazing. But what I would tell my founders going into the trauma of this big correction that we've been living through is, look, there's still plenty of money in tier 1 venture. They have loyal LPs. They're not out of cash. They've got a lot on their mind. They got to worry about triaging their portfolio. But net, here is what's going to happen. This, by the way, has changed. At the beginning of the trauma, I said, if you're in the top 1% of all founders, nothing's changed. Rounds are going to go fast. Rounds are going to go high. Rounds are going to go high. If you're in the top 2 to 10% of all founders, it's going to take longer. Deals are going to get done, but they're going to spend more time, do more diligence, and pay less. And if you're not in the top 10%, don't waste your time. Now, I'm not even sure the top 1% gets fast. I mean, the top 1% plus GAI for a while, okay, fine, fast and furious and really expensive. But now, like, here's the thing about venture, nobody wants to do deals really fast and pay really high prices. It's not like they're sitting around going, should we pay 100 times revenue? Seems like a good idea. No, nobody wants that. They do it and they make the following excuse. And it drives me insane. They make this excuse too often. I'm okay with this excuse if you use it once every 5 to 10 years. I'm not okay with this excuse if you use it once or twice a year. Well, we're going to have to pay 100 times revenue, but hey, if it's Facebook, it's not really going to matter, is it? Yeah, that's true. I'm only going to pay $1 million for this lottery ticket, but as long as it's a winner, it's not going to matter, is it? $1.2 billion for the most recent lottery Powerball or whatever. Yeah, okay. That's not a logical fight. So if very, 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 very rarely you have that level of conviction and you want to pay any price, fine. I went through this experience with another partner on Figma. Actually, it was pretty interesting because we didn't end up doing that deal. The partner wanted to do it, but got absolutely no support. Price was crazy high. But I said, look, if this is the one you think it is, you should do it. Unfortunately, I was the only person that said that. And I wasn't the one that was going to convince them one way or the other anyway. But, it's nobody wants to do deals at super high prices, and nobody wants to have to do a deal in a week. There's a whole bunch of game theory BS out there that sort of people teaching entrepreneurs to manage their process in a way that's very destructive to everybody, including the entrepreneurs. Imagine you use game theory to get a bride, right? I'm a man, so I say bride. If you're a woman, you can say husband. You use game theory to find that person and manipulate them into marrying you. How is that going to work out, right? I've been married for 30 years. It took me 9 months to get my first date. Like slow and difficult process. But I'm a tenacious son of a bitch. And if there's something I want, it's really hard for me not to, I'm not a fan of giving up. So I think there's a healthiness to processes that take a normal amount of time. Now, you always need time pressure. You always need competitive pressure. There's lots of elements of raising a round that are important, but there's nothing wrong with a round taking 30 to 60 to even 90 days, and for the investor to be able to do the actual diligence they need to do, and for you to do it as well and to get to know that investor. You're entering into a marriage. These things take, I used to tell my founders it's 7 to 10 year journey to get to IPO or material exit. Now it's easily 10 to 15. And here's the thing, when you sign a term sheet with a major investor, you're entering into a marriage with a one-way prenup. You cannot divorce them, but they can absolutely divorce you. So you better be with the right partner, because you're going to be with that partner for a long, long time. And I think that is something that is often spoken about, but seldom truly internalized. People don't do diligence on their investors at the level that they should. Some do, but it's pretty rare. Now, everybody says, it's funny because there's so much BS in this industry. I get it. It's fine. I was an entrepreneur for a long time. Oh, yeah, no, you guys are by far the best. You're the reason, we really love you because you're great and blah, blah, blah. Oh, really? Yeah, That's like, there's no such thing as a bad question. No matter what a VC asks, oh, that's a great question. I have a slide for that. Or, oh, that's a great question, blah, blah, blah. I want to do a fake pitch to VCs. I want to come up with a business super exciting and just go pitch all the sandhill firms just to mess with them. And then when they ask a question that's stupid, which people do, not all VCs are smart, but they're not all wise. And they're certainly not all wise in every industry, right? And there's one or two that just aren't smart enough to be in the game, but they are anyway. So anyway, I want someone to ask me a dumb question. I want to say, that is a really stupid question. And I'm not willing to answer it because it shows a total lack of understanding of what I'm doing. So let's move on, and maybe somebody smarter in the room can ask me a question instead of saying what everybody, oh, that's a great question. Yeah, no, it was, anyway, sorry, I'm ranting. But it is funny. You sit in a partner meetings and you just like, oh my God. About both sides, by the way. Sometimes the entrepreneur, you're like, oh, and sometimes there's a partner in your group. You're like, oh, really? Did you not see page 3? The question you asked, which is, we're on page 5, you're asking a question that literally was the entire topic of page 3. You're going to make it that obvious you were doing email the whole time. Thanks. It really helps us win. Anyway, sorry.
That's amazing. Thank you for the insights and anecdotes. But we're going to go with some questions. I see a few people asking questions, and who are joining us today. Feel free to ask. We have about 15 minutes to go through them. So the first question from Oleg, he's asking, what is the best niche to invest in 2024?
So, it's funny. I will often I said I don't like pivots, but it doesn't mean my companies always succeed without pivoting. And so one of the things that will sometimes happen is a company will go to a certain level and realize they can't make it and decide that it's a failure and come to me and say, didn't work out. I have 50 cents on the dollar left. You want it back? I've had this happen 3 or 4 times. And I always say, I invested in you. I also invested in your idea, but let's figure out something new. And I encourage people to sort of go find the way that they think best. If you like to hike and that makes you think, go hiking. I think well when I drive, so maybe I go driving. Maybe you want to go on a silence retreat. I don't know. There's so many different things people like to do these days. Why do I bring all this up? But they often say to me, okay, can we sit down? And I say, yes. And they say, okay, what's the hot category I should be focused on? And I always say the same thing. It's the wrong question. What's hot today is irrelevant because this is such a long journey. You need to figure out what's going to be hot 7 to 10 years from now. And that is not because you're going to be able to predict the future. You're not going to be able to sit there and say, oh, well, GAI is big now, so training of GAI data will be big tomorrow, and then the infrastructure for that will be big the next day, and blah, blah, blah. No. Great entrepreneurship comes from an entrepreneur identifying an opportunity that is an unmet need that he or she can fill in a phenomenal way. That's a great description of how Parker found what he found, right? Now, he did it through questing and learning and interviewing, but he found it. What I learned finally, people used to always ask me early on, what are you looking for? As if there was a formula. There's not a formula, not for me. I'm not an engineer by training. I don't have a checklist of, because there's so many engineers that run companies. I mean, most of my great founders are engineers, but the engineering mindset is a very specific type of mindset. And so there's often a belief that there must be a very specific formula or a trick, or everybody wants to build it in a code. Well, won't GAI wipe all this out? Absolutely not, man. Why don't you tell me how your gut is there, GAI? Good luck with that. Because gut is critical. And gut is basically your entire life's learnings expressing itself through your subconscious mind. But what I finally realized when people said, what are you looking for? Is this a pithy, simple little saying that took me about 7 years to get to. I am looking for entrepreneurs that make me say, wow. Wow is the big thing to invest in right now, wherever you find it. And I have no idea what it's going to be doing or who it will be or where they're focused. I'm not a thesis-based investor. It's very rare I invest behind some specific thesis. I want to receive as many pitches as I can. That whole 8,000 number, like I'm just taking it in. And I'm waiting for the one that makes me say, wow. I would love it if more of them made me say, wow. I was a freelance food and wine writer. And I once went to a tasting where I decided I would taste every wine there. There was 127 wines, Zinfandels. After about 100 wines, I was like, oh, this was a mistake. Now I'm sipping and spitting. I'm not actually drinking, but even then. But what I realized over time is when you taste that many wines, for something to stand out, it has to be off the charts. Usually with an enormous amount of fruit, might be a particularly high level of alcohol or something that makes it stand out from the sea of well-made quality wines that are just not that different from the other wines, right? That's what this is like. Constantly tasting and sampling lots and lots and lots of business ideas until one just makes me say, wow. So the only answer I have is whatever makes you say, wow, is what the right opportunity is to invest in this period of time.
Great. And the next question from Alexander. What is your take about right time for the company to be sold?
Well, a couple of things. It is, there's an old saying, there's so many old sayings, and they usually have a lot of truth that companies don't get sold, they get bought. There are 2 times companies get sold. The one time is when someone wants to buy you and is willing to pay enough that you care. And the other time is when you have no other choice. Those don't work well. You want to avoid those. But I will tell you that you should start working on the relationships that will allow your company to be bought from day one. I'm going to use a very specific example of this. I funded 2 companies very early on. They were 2 of the first companies I funded. They were both doing slightly different things in the same space, but they pivoted, tacked really, until they were doing exactly the same thing, but for different buyers. This one got to 100 million of revenue. This one got to 50. Now, they both sold within a quarter of each other. They both were surprises to me that they sold. I wasn't that active with the companies. I was a small investor, but I checked in with them every quarter. And the one that made it to 100 million in revenue sold for 58x. That's how much I made. Almost 60 times my money. It's one of my top 10 outcomes. How much do you think I made on the company that made it to 50 million of revenue? Well,
Same.
I lost all my money. I didn't make a penny. So the average of the two was 29x, which is not bad, but I sure would have been happier if the average of the two was 58. And the big question for me was always why? Well, this company got bought by a business they had started working with, Twitter, at the beginning of their existence. And they had built partnerships and relationships all the way through. It was like a probably 5-ish to 7-ish year journey. This one scrambled to sell at the last minute. And they got pretty close. They actually had a pretty reasonable bid that would have made us all money until the bidder figured out they were the only bidder. And then they started turning the screws. And in the end, they paid the company the amount of debt that it owed to its debt provider, and the equity got zero because the buyer was in control. So I would argue that the biggest impact on those outcomes was the length of time and relationships that had been built to allow those buyers to see something that they wanted and to understand why it was valuable to them. And almost certainly they had tried to buy it in the past. Every big acquisition you see isn't the first offer. One, the first offer is never the highest offer. I mean, that's sort of basic, but amazingly, a lot of people don't understand that. I do a lot of coaching on acquisitions when the time comes, and sometimes people listen, sometimes they don't. But the other thing is usually they've been trying to buy it along the way, and it got more and more valuable, and the prices went up, and then finally there was a meeting of the minds. But it is, so, I think you almost have to do two things simultaneously. Always run your business as if you're going to sell it and never have any interest in selling it. I'm actually not interested in businesses that get sold. I'm not saying 58x isn't great, it is. But I need to believe there's a future IPO in your life. If I don't, I'm not funding it. I'm not saying that's where it'll end up. I've got 5 or 6 companies that have become public over my investment history as a seed investor. I've certainly funded a lot more than that. And so I've got plenty of great acquisition out. I've got 2 that were 58 to 60x that were acquisitions. So I know that is the reality, but companies that could become public, that have the viable ability to be at that level, are going to sell for a heck of a lot more. I think when you build a business to sell it, there are people that are effective at doing that. I don't really know how. And it's not really how I think about the world. You got to shoot for the big time.
Yeah.
I should say one thing.
Good advice.
This is fair to everybody. I am giving you the view through the lens that I look through. Okay. Remember when I said it matters a lot what people need? Well, want versus need. I don't need to be a billionaire. Would I like to be a billionaire? I don't know. Probably, as long as nobody knew, right? Because I don't want people to know I have that kind of cash. But am I going to do what it takes to become one? Well, I might get lucky and my phenomenal companies might get even bigger than I think, and maybe things go even better than I hope. But realistically, I've done really well and I plan on continuing to do really well, but it's not on my list of needs. If I needed to be one, I'd probably lead a slightly different life. I don't know how much more work I could do. I'm already working crazy. But whatever you need is usually where you'll stop. So let's say, as an example, that you grew up in a town where let's make this very simplistically venal and only about money. That is not what life is about. It's not what entrepreneurship is about. But just to make the metaphor simplistic, you grew up in a town where the richest family in town had maybe $10 million. And you've always wanted to be the biggest dog in that town. If you have an opportunity to exit where you keep $20 million, pretty likely you'll do so, because now you will, in fact, be the biggest dog in that town. Apply whatever number you want. I don't really care. 100 million, 200 million, whatever. So you want to plan your business around your need, not your want. And part of that is figuring out who your investors are going to be. I have absolutely no interest in those sort of outcomes. Now, that doesn't mean they're bad outcomes for the founder, But here's the thing, an investor is building a portfolio. I think of it this way. This is probably not the best metaphor anymore because of where we are in the world, but I'm building an elite military unit. I used to say I am building the Israeli army because they are the single best fighting force in the world. And then I would compare things like, spray and pray investors to building the Russian army because they'll throw an unlimited amount of humans at it and they'll give them pitchforks if they need to, because what do they care? They seem to feel their citizens are disposable. That's spray and pray investing. But whether you're spray and pray investing or building an elite army, at the end of the day, you need to win the war. You need to take the hill. And unfortunately, in war, not all the soldiers come home. For the general leading that military, that is an acceptable loss as long as they take that hill. For the individual soldier, it is not. But I, as a quote unquote general, is an exaggeration. It's an unfair way for me to categorize myself. I need all my fighters to be out there 100% looking to take that hill. And when a certain percentage of them do, I win, and the others are part of the cost of doing business. But that's because I have a portfolio. You, as an entrepreneur, are your portfolio. You don't have that same flexibility. But don't take money from people like me that want you to fight to the death to take the IPO hill if you're perfectly happy taking the small village hut to the right that's worth $100 million, right? Because that's just going to lead to a lot of conflict, a lot of problems. And if it's a major investor with rights, you probably don't have a job anymore once they figure out that that's what you're actually shooting for. When you told them you were shooting, every entrepreneur, it's at least $1 billion opportunity. But in their hearts, what is it going to be? Because if it's not $1 billion opportunity and they're not going to, if it is $1 billion opportunity, but you're going to pursue the $100 million exit, you have a reasonable chance of getting replaced. It's a dangerous way to go. So take the money from the people that are okay with the $100 million exit.
Very, very good advice.
All right, we are almost out of time. You want to do speed questions? We'll do
Yeah, maybe, yeah, we have 2 minutes, so I don't know.
Okay.
You want to take
1 billion people in the
that,
last 30 to 40 years. We add access through remote work to many more talents. Why is it still so hard to find great people? Well, finding great people will always be hard because they're extremely demanding. When people are great, they want to work with other great people. They want to work in great opportunities. So you have to sell them on why you are the great opportunity. Storytelling is incredibly important. It's how you raise money. It's how you get those great people to work for you. It's how you get clients. It's critical. Great people are not going to show up, right? So if you want to build the Navy SEALs, you better have a recruitment program that's going to get you Navy SEALs to care. They want to be amongst other Navy SEALs. There's a reason they don't want to be part of the regular Navy, okay? But they want to join an elite fighting force. You get great people by only hiring great people. I know it's a hard starting point, but you better be great to start with. What are your recommendations on doing due diligence with angel investors? Well, number one thing I would say is ask them for references. Then look at their website or LinkedIn page, in my case, and look at the investments they've listed. Then Google the crap out of them and find anybody they didn't mention or list. Call those people, right? Because those are the ones where it didn't work out. And, angels, I mean, I don't know how much diligence you do on angels. What are they going to do anyway? They're not going to show up. They wrote you a tiny check. It's investors that are giving you a priced round term sheet you need to care about. 2 questions. What's a big market? Does a pitch deck have to be fancy? Absolutely not. So a big market is massive. The bigger, the better. Like I love it when I find trillion-dollar markets. Those are super rare, but I like it when I find them. Pitch decks should be, who are you? What are you doing? How are you doing it? Who are you doing it for? And how much are they paying you? And they should be simple. Your job is not to stop when there's nothing left to add. It's your job to stop when there's nothing left to remove. Every single thing you put on a pitch deck page has to earn its place. Everything on a page that I'm reading is taking me time away from looking at and interacting with you. Be really protective of what you put on a deck. Everything, every single word, you question it. I do this with my entrepreneurs all the time. I'm like, why do you have the word "the" there? And like, I'm exaggerating to make the point, but add the word "the" 30 times in a 12-page deck, and 12 pages is too long. That's a bunch of time you just wasted with me reading it. What for you are 2 of the secret ingredients of a wow pitch deck? I go back to clean and simple. First page, I'll give you my recipe per deck and then we'll be done. First page should be your logo, okay? The name of your company if it's not in your logo, and your elevator pitch, and literally nothing else. but I want to immediately start thinking about what you're doing. And if you can't tell me what you're doing in one line, you got work to do. I had somebody once explain nuclear fission to me on a Post-it note. If you can't explain your business to me in a line, you got to wonder which person is the one that has the issue. Einstein used to say, if you can't explain it simply, you don't know it well enough. Okay, second page, team. Early stage, it's all about the team, man. I need to believe in the idea. I need to believe in the market, but I got to bet on you. It's not like your deck is running the company, is it? So second page is the team. Then what do you do? And then who do you do it for? How do you price it? How's it going so far? That's pretty much what I need to know. Now, I can then ask all kinds of questions. There's a lot more work to be done. But remember that a deck is just the hook in the mouth. You cannot get that VC fish in the boat without an enormous amount of work. But you can't do anything until you get the hook in. Keep it simple, keep it clean, keep it precise. Specifics are your friend, generalities are your enemy. A last thing I will say, if you go on my LinkedIn page, and I read 100% of my messages on LinkedIn and on Twitter and everything. I'm always looking. It says something very clear right under my picture that most people ignore, and that infuriates me. It shows me they're just spamming me. They typed in investor and hit everybody with the same crap. Ben Narasin, founder and general partner, Tenacity Venture Capital. Pitch me your idea with a one-line elevator pitch and ARR if you have any. I don't do security, medtech, or crypto. What do I get? 8 paragraphs on some medtech. Okay. What I respond with is a picture of what I just described with a circle around it. You give me a one-line elevator pitch. If you have ARR, you tell me what it is. Then I will know if it's something we should spend time talking about. You're not going to sell me the whole business in a one-line elevator pitch. But okay, yesterday I had lunch with somebody as a favor to a friend. Blah, blah, blah. We do all this stuff for digital assets. I said, you mean crypto and NFTs? Yeah. I don't do crypto. I can help you with your deck as best I can, but you should know from minute one, I don't invest in your category. They did want to spend the time. We did work on their deck, but net, like, you know, the one-liner, maybe I had another one, 6 paragraphs. I send him a picture. He sends me back, we do X, Y, Z. I have a competitive investment. I said, I have a competitive investment. Boom, done. He probably regrets that he sent me the 6 paragraphs, right? Because why should he? I've got a competitive investment. I'm not going to share anything with anybody, but how does he know that? Well, I appreciate the time. Anybody that wants, I'm at Ben Narasin. Obviously, I'm on LinkedIn and Tenacity is on LinkedIn. Feel free to reach out. Elevator pitch, though. Because if I don't get a one-liner, I know you did no research. You basically just hit send 100 randos, and no matter what it says, dear first name here, like, yeah. We really believe that fill-in name of fund here is the single best partner for us because of your exceptional investments in fill-in name of 2 investments that we found on LinkedIn here. I mean, like, nobody's that stupid that they think, oh, they picked me. Oh, I'm so special. Oh, isn't that nice? Okay. I don't need my ego assuaged. I just need to know what you're doing. And I can tell you if I can be a potential player.
Thank you, Ben. It was great to chat, and I wish you a wonderful day ahead.
All right. Thanks for having me. Take care.
Thank you. Bye.